In Chapter 1, maybe the most important thing for you to take out of Chapter 1 is some of the basic terminology. There are certain terms that you're going to use in every single chapter. You can't do Chapter 2 unless you know some of the basic terminology in Chapter 1. And all of the terms in Chapter 1 are important, and I would encourage you to look at the terms in the back of the chapter. I've picked out some terms that we will use in every single chapter in this book, and thought that it would be good to reinforce the knowledge of some of these very important terms. So I've set up a matching problem that I thought we would review some of these terms with. So we've got 6 terms in this matching problem: assets, expenses, owner's capital, revenues, liabilities, and equity. Let's just take these one at a time. We're going to start with actually the actual terms there, the definitions A through F, and we'll take one at a time. And as we go through this, see if you recognize the answer to these. First off, A, what a company owes its non-owners, which we actually call creditors. Do you know what the answer to that would be? Well, that's a liability. Liabilities are what we owe our creditors. Examples of liabilities would be like accounts payable, bonds payable, notes payable, salaries payable, so forth and so on. Let's go to B. B says, resources owned or controlled by a company. These are things of value that the company owns, controls, and uses for the most part. What would that be? Well, did you say assets? If you said assets, that is correct. Assets would be like cash, accounts receivable, land, building, supplies, prepaid rent, etc. C, assets an owner puts into the company. The owner, to gain ownership in a company, the owner has to give the company something. And so assets an owner puts into the company. If you answered owner's capital, that is correct. D, owner's claim on assets. The owner has certain claim on assets, and if you answered D for number 6, you got that correct. Now, it's a little bit confusing here. I want to clarify the difference between owner's capital and equity. Equity is, and we're really saying the same thing here with owner's capital and equity. Equity is the general term for any owner, regardless of what structure of business it is. Equity is the owner's claim on the assets. When it's a sole proprietor or a partnership, we call it capital, like it might be Kidd Capital or Smith Capital or Jones Capital, and that represents the assets that an owner puts into the company. Okay, let's go to E. E says decrease equity and are the costs of assets or services used to earn revenues. Decrease equity and are the costs of assets or services used to earn revenues. Revenues don't just generate by themselves. We have to do things to generate revenues. And if you answered expense for E, that is correct. That's part of the cost of generating revenues. And you can have any number of different types of expenses: salaries expense, rent expense, supply expense, so forth and so on. And then the last one you can figure out by matter of elimination, of course. F, increase equity and are the assets earned from a company's earning activities. And if you answered revenue for F, that is correct. And typical names for revenue, typically companies will use their type of business as the descriptive term for the revenue. Like a lawyer, for example, might call their revenue attorney fees earned or attorney revenue. An accountant might call it accounting fees earned. A realtor might call it commissions fees earned. Typically, companies will use some type of description to describe the specific name for their revenue. So again, I would encourage you to go through the rest of the terms. If you don't understand these 6 terms we just went over, review them again and again and again, because we will use them in every chapter. The end product of a financial accountant's work is the financial statements. And here in the textbook, or in this class, we are going to actually start with financial statements. But I don't want you to get confused and think that financial statements are the first thing in the accounting process. Actually, financial statements are the last thing in the accounting process. But here we are going to cover financial statements in Chapter 1 to at least give you a brief idea of the finished product. I thought as a good review of financial statements we would do some exercises in the back of the book. So go ahead and get your book and turn to page 32, and I'm going to do the same thing. I'm going to get my textbook here and turn to page 32, and we're going to first do exercise 1-13. In exercise 1-13, they ask us to prepare an income statement. And the very first thing you do when you prepare any financial statement is you have to identify the document. It's very important in accounting to identify documents. So we're going to have a heading for each financial statement. And here is our heading for exercise 113. First off, you start off with the name of the company. The name of this company is Real Answers. Then you identify, okay, what document is it that we are producing, and it is an income statement. And then very important to identify the time period. An income statement attempts to explain a period of time. In our exercise here, we're going to try to explain what happened during the month of October. So therefore, in our heading, we put for the month ended October 31st. Think of an income statement as like a video camera. It's showing what happened during a period of time. First thing that goes on an income statement is revenues. And so you start off, in this case, our only revenues, as you look in the exercise, our only revenues is consulting fees earned. So we start off with a section called revenues, and then the specific name of the revenue, consulting fees earned, $14,000. The next item to go on the income statement is expenses. Actually, the only 2 items that go on an income statement are revenues and expenses. Do not make this more difficult than it is. That's all that will go on an income statement forever and ever and ever is revenues and expenses. So as you look at exercise 1-13 there are 4 expenses. The last 4 items listed are expenses. And so we put the expenses below our revenues, something like this. You see we've just simply listed our 4 expenses: rent expense, salaries expense, telephone expense, and miscellaneous expense. And I put those 4 expenses in one column, one right below the other, simply because I'm going to add them up. It's going to make it easier for me to add those 4 expenses up. There's no accounting rule that says they have to go in a particular column, but I'm just trying to use as a useful format as possible. So we add up those 4 expenses, and they add up to $9,460. And notice that out of a matter of convenience, I put our total expenses below our revenue. The next and last step in preparation of the income statement is to subtract the total expenses from our total revenues. So we subtract the $9,460 from the $14,000, as you see we did there, and that gives us net income of $4,540. So in summary, an income statement just simply shows your revenues, and you could have more than one. In this example, we only had one, but you could have more than one type of revenue. You list all your revenues, you list your expenses, subtract your expenses from revenues, and you end up with net income. The next financial statement is a statement of owner's equity, and we're going to use exercise 1-14 as an example of statement of owner's equity. So please go ahead and turn to page 32, and If you would like to go ahead and pause this presentation to give you an opportunity to read through this short exercise, feel free to go ahead and do that. A statement of owner's equity, it summarizes the changes in ownership from the start of the accounting period to the end of the accounting period. Okay, so let's go ahead and let's prepare our statement of owner's equity. What's the first thing we do on preparation of any financial statement? You're right. We prepare the heading. We need to identify the document. So here again we identify the name of the company. It's Real Answers. And we identify what is the document we're producing. We're producing the statement of owner's equity. And then very important, we identify the time period. Well, a statement of owner's equity, like I said a few seconds ago, it explains how ownership changes from the start of an accounting period to the end of an accounting period. So a statement of owner's equity is telling us what happened during a period of time. So we have to identify the period of time, and in this case, it's for the month ended October 31st. Okay, so again, I said that it attempts to explain how ownership changed from the start of the period to the end of the period. So logically, a statement of owner's equity is always going to start with what the ownership was at the beginning of the period, or capital. Capital represents ownership in a sole proprietorship like this. So we're going to start off with our beginning capital, and this is a brand new company, as it indicates in exercise 114. It's a brand new company. So, and the owner's name is King. So we write down King Capital October 1st, October 1st being the start of the accounting period. In this case, it was 0. So we just put 0 there as the beginning capital. Now, the only time it's going to be 0 is when it's a brand new company. Most of the time you're doing a statement of owner's equity for an existing company, so you're going to have a figure in there for the beginning capital. Okay, there are only two things that will ever increase the ownership of a sole proprietorship like this. One of them is if the owner makes an additional investment in the business. Obviously, if you make an investment in a business, you want ownership. And then the second thing that can increase ownership in a business is net income. Well, in this business, Real Answers, we had both. K. King invested $84,360 in the business during the month of October, so we include that in there. And then, as we know from doing exercise 1-13, the business, Real Answers, generated net income in the October accounting period. The net income was $4,540. So we add those two together, and we get the $88,900. Okay, the next step then is to put on the statement anything that might reduce ownership in the business. Well, there are again only two things that reduce ownership in the business, and they are the total opposite of the two things that will increase ownership in the business. We said that an additional investment by the owner will increase ownership in a business. So what would be the opposite of that? Well, it would be if the owner takes something out of the business for personal use. That would be called a withdrawal, and that decreases the ownership in the business. Then net income, we said, increases the business. Well, what's the opposite of net income? It'd be net loss. And obviously we didn't have a net loss in this case. You can't have a net income and a net loss. So the next part of our statement of owner's equity will just be the $2,000 withdrawal that King made in the business during the month of October. That decreases ownership. So notice I subtracted the $2,000 from the $88,900 to get ending capital or ending ownership of $86,900. And that's it for the statement of owner's equity. And Clay, that ends that one. The third financial statement we're going to work is a balance sheet, and it is exercise 1-15, again, page 32. So again, like on the others, go ahead and pause me and take a minute to read through exercise 1-15, and we will work a balance sheet. Well, what's the first thing we do? Again, you should know by now, we need to identify the document. We need to put a heading up. So we're going to put a heading up, and again, it's going to be amount to 3 different lines. The name of the company, Real Answers. the document we're producing, this is a balance sheet, and the date. All right, let me explain the date. The balance sheet tells us what we have at a point in time. It doesn't tell us what happened during, say, the month of October. It only says, here's what we've got, here's our situation on October 31st. So notice on the first two financial statements, we identified the time period as for the month ended, because the first two financial statements, an income statement and a statement of owner's equity, identified or showed what happened during the period October. It's not the case with the balance sheet. The balance sheet says, here's what we've got on October 31st. And so we just simply put the date, October 31st. All right, a balance sheet is composed of three items: the assets that we have on October 31st, the liabilities we have on October 31st, and the ownership or capital we have on October 31st. Do you recognize those three things? What do we call that? You were correct if you called that the accounting equation. The balance sheet represents the accounting equation. So let's start with the assets. You always start with the assets and list your assets first. So looking at exercise 1-15, we've got 5 assets. We've got cash, we've got accounts receivable, supplies, land, and equipment. Those are the assets we have in this particular case. We put the number, the appropriate number by each asset, add them up, and we get $111,937. The next part of the balance sheet is liabilities. And so look at exercise 115 and see what liabilities Real Answers has. Well, they only have one liability. It's just accounts payable of $25,037. Now, as you recall from the accounting equation, you remember that assets equals liabilities plus owner's equity. So we've come kind of to the moment of truth with our balance sheet here, because we know what our capital is. We just calculated our capital in exercise 1-14, didn't we? We calculated our ending capital. We're going to put that figure in here next, and we know that assets equals liabilities plus owner's equity. So if we did everything correct so far, this is going to prove out. We're going to be able to add our liabilities plus the capital figure we're about to put in here, and it should equal our total assets of the $111,937. So I put that capital figure in there of $86,900 that we got from the exercise 1-14, the statement of owner's equity, and add that to our accounts payable, our only liability, and that does indeed equal $111,937. So everything worked out.